Minister Tharman, welcome. Thank you for taking the time.
Pleasure.
The IMF's policy steering body met today amid a subdued and uneven global growth outlook. Can you give us a sense of the discussions?
I would say the mood has been consistently positive and constructive. By that, I don't mean that people were trying to sort of talk away the problems, but that everyone acknowledged that there were problems, they can be solved, and there were some things we could do to cooperate with each other so that we arrive at global solutions to some global problems.
We've heard a lot about emerging markets at these meetings. The fact that they're transitioning to a slower growth path. What message would emerging markets take away with them?
Well, I think basically the emerging markets are first taking some cyclical knocks. They were growing extremely rapidly in the last few years, some above potential, and there's a reversion back to potential. For some of them, it's also a matter of a new structural setting, not just taking a cyclical knock, but moving to a new structural setting because the demographics are changing. China is the most important example of this. The labor force is slowing down, they're reaching a new phase of development, and they are resetting the path of growth. Now that's a positive. It looks like lower growth rates, but it's actually a positive because it's about sustaining growth and not overheating the economy and then facing a major correction further down the road. Several other economies are in the same situation, resetting their structural path of growth, moving on to a new footing. For instance, not growing so much by labor force increases, but more by productivity increases, skill improvements and innovation. So by and large, changes in growth rates in the emerging economies, if you strip out the cyclical aspects, which are transitory, are basically about moving on to new phases of growth as they move up the value curve and as they move up the income curve.
But now, you have the much anticipated exit from U.S. unconventional monetary policies. How can emerging markets cope, and how should they prepare for that eventual exit?
Well, first, I found it very encouraging that virtually all my colleagues on the IMFC from the emerging markets saw the eventual normalization of interest rates as a net positive, because it means the global economy is recovering, the US and the advanced economies are recovering, and on that basis they will see a normalization of interest rates. Next, the challenge of transition. From now until the point at which interest rates start normalizing, we've got to prepare ourselves. And that means that we've got to do more. First, make sure that we all get our house in order. It's not just the emerging markets, but everyone. Second, it means that during this transition phase, it's more important than ever that we get our structural reforms going, get momentum into our structural reforms. The last thing we should do is leave the structural reforms to the time when it's critical. Start doing it now, when we're still in peacetime. Get the structural reforms going, explain to our populations why they're necessary, and explain that this is really a path to higher incomes and better jobs in future.
Let's turn to low-income countries. They've proved to be very resilient. How can they sustain that?
Well, the low-income countries, a very large group of countries, a very large group of IMF members, first, some things have changed. Commodity prices may not be the same in future as they've been in the past, particularly on the mineral side. And it's partly a consequence of the fact that China's economy is changing and the global economy is changing. Diversifying away from commodities is still a key development task. Diversifying sources of fiscal revenue away from commodities and diversifying jobs away from commodities. And that's an area in which the fund is very closely engaged with them on, working closely with the World Bank and other agencies. And they'll come out of it well. Again, there's a sense of realism and optimism coming out of realism that I find very encouraging amongst our low-income countries.
What do you see as the main policy priorities going forward?
First, very often if you look at media reports and if you look at some of the discussions that sort of get into the blogosphere, you get the impression that there are very different solutions for the advanced economies and the emerging economies respectively. And you often get the solution that they are talking at cross purposes or pointing fingers at each other. Our meetings are very different. If there's one thing that comes out of these meetings as a very simple takeaway, is that the advanced economies and emerging market economies, although at different stages of development, have very similar policy challenges. First, getting our macroeconomic houses in order, and in particular, getting credibility in medium-term fiscal consolidation. We don't have it yet in the United States. We are getting it in some European economies, and we have it in several emerging economies already. So medium-term fiscal consolidation is critical for those that have large debts. Second, the structural reforms. Remarkable similarity between the advanced economies and the emerging economies. Deregulation, major priority in Abenomics, major priority for countries like Germany, a relatively successful European economy. Same issues in the emerging market economies, opening up economies to competition, both for foreign investors as well as more domestic competition. And the services sector in particular can do with a lot of deregulation across the world. Thirdly, labor markets. Europe isn't the only continent with a labor market, with a rigid labor market problem. Several emerging economies have the same problems, and making sure that we always keep the labor market open to the young, to women, and to minorities is critical. So the policy lessons coming out of the advanced economies are being borrowed by the emerging economies, but you're also getting some reverse lessons.
Thank you very much, Mr. Tharman.
Thank you.